Hello, welcome to the ongoing Attract Capital webinar series. I am your host Sarah and I'm here with Attract Capital CEO Dave Barnett.
Hi everybody, how are you?
So today we're going to discuss why mezzanine debt is ideal for management buyouts. So before we get to the main theme, Dave, can you tell us exactly what mezzanine debt is?
Sure, Sarah, I think I can do that. Mezzanine debt is a cash flow based financing loan based on the future growth of the company. It's great for acquisitions and for scale-ups. It's provided by specialized funds across the country, and it's very different than a bank loan. In a few important ways.
Okay, I think I understand. Is it more like an equity investment or something else?
That's a really good question, Sarah. It uses the same valuation approach as an equity investment, but it is not an equity investment. It is much less expensive than raising equity, and it's a great way for companies to raise a significant amount of capital.
Okay, so you said it's good for a management buyout. So
Yes.
What happens in a management buyout?
Okay, sure. So in a management buyout, management buys the company from the current owner, and they usually use a lot of loans or debt to finance the purchase price. And in doing so, they become the majority equity owner of the company.
Okay, gotcha.
So the people that are running the company end up owning the company.
All right, okay, so now that we kind of have the pieces, how do they fit together? So why is mezzanine debt good for a management buyout?
The reason it's good, Sarah, is because mezzanine loans are much bigger than regular bank loans. And because they can lend deeper into the capital structure, they usually end up providing 100% of the funding that the management team needs to be able to buy the company. And the nice thing about it is that usually when you're doing a management buyout, you have to bring in a bank and then you bring in a mezzanine loan for the amount that the bank can't provide. But when you use all of the capital need for a mezzanine lender, you're only working with one lender, which makes it easier to close.
Yeah.
And then one of the other nice things is that if equity, as you mentioned earlier, is needed in the transaction, the mezzanine lender can usually provide a small amount of equity, but at a much lower price than an outside equity investor would. Stylistically, mezzanine lenders are very patient investors, and they have very long-term principal repayment structures. Usually 100% of the loan is repaid on the back end or at the maturity, which is 5 or 6 years. So it gives the company the ability to take that growth step, and then when it's much bigger and has the money to be able to pay back the loan, it can pay it back. And then finally, the last answer to your question, they tend to be very good people. They're very management supportive, and if you need more money as you're going through your growth journey, they're often very eager to provide it.
Oh, well, that sounds like a great option. I would love to have somebody that I can ask if I needed more money. So thank you very much for that explanation. So there you have it. For all of you management teams looking to do a buyout, mezzanine debt is the way to go, and it's the capital for you. So Attract Capital can help you get it. Thanks for watching, and be sure to tune in to future webinars.
Thank you.